Good day. In this video, we will take a look at the different capital gains tax exclusions and rollovers for individuals. In the previous video, we discussed the determination of proceeds and the base cost. The focus for this video will be the different exclusions and rollovers. The first exclusion that we will deal with is the primary residence exclusion. A taxpayer who disposes of their primary residence for proceeds not exceeding 2 million should disregard their capital gains. The key here is the amount of the proceeds. So where you have a taxpayer that disposes of their primary residence for proceeds not exceeding 2 million, they will disregard all their capital gain, but there's certain rules which we will discuss later on that apply in terms of interrupted residences or where you have portion of the primary residence being used for trade purposes. But we will get to that just now. If you have a taxpayer who disposes of their primary residence for proceeds exceeding 2 million, they should disregard 2 million of the capital gain that they make. Now, there are a few things to take note of in terms of the 2 million that should be disregarded. And they are that the exclusion is per property, meaning if the residence is owned by, for example, spouses equally, they will each get an equal share of the disregarded portion. The land size that is excluded is limited to 2 hectares. So you have an example, or you can have a scenario where you own property in a farm, for example, and that farm has a land size of about 5 hectares, right? So the portion of the gain that will be subject to the primary residence exclusion is only limited to 2 hectares. So meaning 3 hectares of that 5 hectares will not be subject to the primary residence exclusion. If there is interrupted residence, meaning if there is some sort of absence from the residence by the taxpayer, then the amount to be disregarded needs to be apportioned. We will talk soon on that. Lastly, if there is a portion of the residence which is used for trade purposes, then the exclusion needs to be apportioned as it only relates to property used for domestic purposes. Refer back to your definition of what a primary residence is, right? That is why we have this exclusion. So it will only apply to the portion that relates to domestic use. Please note that temporary leasing is trade unless the taxpayer lived in the residence for more than or for at least a year or more before and after the letting the property. No other residence was treated as a primary residence during the letting, and the taxpayer is required to be away from their primary residence due to employment, and then the distance that the taxpayer needs to be away is exceeding 250 kilometers. So temporary letting will apply is trade unless the following applies, right? So these are and, so it's not or, so all these scenarios must apply for the temporary letting to not be regarded as a trade, right? So if the taxpayer lived in the residence for at least a year before they let their property, as well as at least a year after letting their property, and during this time, no other residence was treated as a primary residence, right? As well as the taxpayer was away for more than 250 kilometers from the residence due to employment. In this case, the taxpayer will be deemed to have resided in the property for domestic use for for up to 5 years. So what does this mean? If the taxpayer was, for example, seconded on a certain project for about 3 years, right? So meaning they were away, they were working, for example, in Gauteng when their primary residence is in the Northwest. They worked in Gauteng, and then they worked in Gauteng for a period of about 2 years, right? They have lived in their primary residence for about 5 years prior to that. So they are seconded in Gauteng, so they spend most of the time in Gauteng, but they don't have another primary residence in Gauteng, right? And then after the 2-year project is completed, they move back to their primary residence in the Northwest. They stay there for about 7 years before they sell their property. There will not be any apportionment in that case because it will be regarded as if the taxpayer was present in the property because they were not away for more than 5 years. So they lived in the property for at least a year. So they lived in that property for 5 years before they moved out, and for 7 years after they moved back in, and they had never had another primary residence, and they were away. They were more than 250 kilometers away. Right. So they will be deemed to be to have resided in the property for up to 5 years. So if the project takes longer than 5 years, then the full period of absence is deemed to be trade use. So that is if they let the property, right? So the full period of absence will be deemed to be trade use. The portion used for trade should not exceed 50%. Otherwise, the property will not qualify for the primary residence exclusion. Remember, the rules for a primary residence is that it must be mainly used for residential purposes and mainly is more than 50%. So if you use your primary residence more than 50% for trade purposes, then it will automatically not qualify as a primary residence and therefore will not qualify for the exclusion. Right. If there is any interruptions in being ordinarily resident or in living in the property, which is what we mentioned earlier, then the exclusion should be apportioned and will only apply to periods of uninterrupted residence unless the property was either vacated due to a new acquisition, or there was a process of building, or the property was accidentally rendered uninhabitable, or the taxpayer has died. In this case, the taxpayer will be deemed to be ordinarily resident in the property for up to 2 years, and thereafter they should apportion the gain that needs to be excluded, right? So if a taxpayer has, for example, vacated the house because they are in a process of selling it, they will be deemed to have been ordinarily resident in the property for at least 2 years. So if the house is in the market for more than 2 years, then they need to make an apportionment. If it's for less, then there's no apportionment necessary. Right. It is important to note that the rules in terms of ordinary residence as well as trade use are applicable to both a scenario where the primary residence is sold for proceeds exceeding 2 million as well as for less than 2 million. The second exclusion that we will discuss is the small business assets exclusion. In terms of the small business assets exclusion, a natural person should disregard 1.8 million of any capital gains made on disposal of active business assets of their small business. It is important to note that the exclusion is granted per lifetime. So that 1.8 million is granted per lifetime. So if a person has more than one small business, the requirements of the exclusion will apply to all of those businesses in aggregate. An active business asset is an asset which is immovable property to the extent it is used for business purposes, or any other asset other than immovable property that is used or held wholly and exclusively for business purposes. There are certain assets that are excluded from being regarded as an active business asset, and those are a financial instrument and any asset used to derive income in the form of an annuity, rental income, foreign exchange gain, royalty, or any other income of a similar nature. In terms of paragraph 57, a small business is a business of which the market value of all its assets on date of disposal of the assets or interests does not exceed 10 million rand. The small business can be in the form of a sole proprietor, interest in a partnership, as well as at least 10% of interest in a company. There are certain requirements that must be met to qualify for the exclusion, and those are as follows. The natural person must have held the small business for their own benefit for a continuous period of at least 5 years prior to the disposal of the business assets. The natural person must have been substantially involved in the operations of the small business during the 5-year period. The natural person must have attained the age of 55 years, or if younger, they must have disposed of their assets or interest in consequence of ill health or other infirmity, superannuation, or death. All of the qualifying capital gains must be realized within a period of 24 months, commencing on the date of the first qualifying disposals. So if you have a person disposing of their active business assets of a small business, they must realize their gains within a period of 24 months, and that 24 months period will begin on the date of the first disposal. Just as a quick recap, we have dealt with the primary residence exclusion as well as the small business assets exclusion. The third exclusion that we will discuss is the personal use assets exclusion. In terms of this exclusion, a natural person or a special trust should disregard any capital gains or losses made on disposal of their personal use assets. There is no limitation in terms of the value to be excluded. A personal use asset is any asset that is not used for trade. Now, for assessment purposes, even though we know the gains or losses should be disregarded, it must still be shown in the calculations, and the disregarding must be clearly indicated. The following assets are specifically excluded from personal use assets, and those are an aircraft with an empty mass exceeding 450 kilograms, a boat with length exceeding 10 meters, and any right in the above. On disposal of any of these assets, the gains will be taken into account. However, the capital losses should be disregarded. So when you have a scenario of a person who has their aircraft being disposed, if they make a gain, that gain will be included in their taxable capital gain calculation. But if they make a loss, that loss should be disregarded. That the aircraft in this case is an aircraft with a mass exceeding 450 kilograms. The capital losses will be disregarded to the extent the asset is not used for trade if the asset is used for multiple purposes. In addition to the three assets excluded from the personal use assets, the following assets are also excluded from personal use assets. That is your gold or platinum coins, immovable property, short-term insurance relating to non-personal use assets, financial instruments, as well as any insurance policy which is not short-term. Now, on disposal of any of these excluded assets, the capital gains and losses will not be disregarded. Remember, these assets are not personal use assets, so the exclusion will not apply. Hence, no disregarding will be applicable. Any capital gain or capital loss resulting from the following should be disregarded by a natural person or a special trust, and that is retirement benefits. So where you have a capital gain or a capital loss resulting from retirement benefits, that needs to be excluded or disregarded. And any capital gain or loss from a long-term insurance should also be disregarded. The rollover that is in scope for us is the transfer of assets between spouses. Please note that this rollover relief is found in Section 9, capital letter H, capital letter H, capital letter B of the Income Tax Act, and it is not in the 8th schedule. A spouse who transfers, that spouse we will refer to as the transferor. A spouse who transfers an asset to their spouse must disregard any capital gain or loss. The spouse who the asset is transferred to, and we will refer to that spouse as the transferee, will be treated as having acquired the asset on the same date on which it was acquired by the transferor, having acquired the asset at the base cost incurred by the transferor, and lastly, having used the asset in the same manner that it was used by the transferor. In simple terms, the history of the asset is rolled over to the transferee spouse. Please note that this rollover relief is not applicable where the transferee is a non-resident, unless the asset is a South African source asset. This brings us to the end of part 2 of the capital gains tax videos. Please look out for part 3 of the capital gains tax videos, in which I go through examples of the principles discussed in the previous 2 videos. Thank you.